Chapter 5. So, in Chapter 4, Chapter 4, Statement of Financial Performance, and we covered the Statement of Retained Earnings, which is mostly for ASPE, but you will see a lot of analysis of just the Statement of Retained Earnings for IFRS. The last two financial statements. So we're going to do the Statement of Financial Position, which is the balance sheet, and Statement of Cash Flows, which I just call SC. Now, for SCF, there's two approaches. Indirect will be reviewed here, and it's what you've learned in intro already, and direct you will not learn till 316. I think it's the very last chapter. Your appendix is not required except for any ratios in the notes or the extras. Okay, so the first section I want to talk about is how to disclose information on financial statements. You've been talking about this, or we've been talking about the first one, ever financial statements, and we also did it in Chapter 4. It's giving additional information, so you can use parentheses, such as you write inventory and in brackets LCNRV, which, if you don't remember, is lower of cost and net realizable value. Or, like in Chapter 4, discontinued loss net of 10,000 tax. So that's one way. The other thing we've also talked about, you haven't had a chance to write many of them, but you can include notes to financial statements and supporting schedule. If you go to CDAR and find Canadian company, well, they'll all be Canadian, financial statement, you can find the section of the notes. And look through that just to see how they look. Cross-reference and contra items. So, cross-referencing is done with related items. For example, if cash was restricted, like we couldn't use some of it because we had to pay off some debts in the next year, it would say cash, and then it would say restricted, see long-term liabilities, and long-term liabilities probably say for restrictions, see cash. Contra, so that's opposite balance. Or adjunct item are separate accounts which are included, such as AR and AFDA, or equipment and accumulator. Now both of those are contra. These adjunct, they have the same balance, so you add them. You will see as we go along and learn new topics for the next few courses. Okay, so Part B, Statement of Financial Position of the Balance Sheet. It's the assets, liabilities, and equity. So this is probably the first statement you learnt. This is what it evaluates. You can read that. Aids in assessing risks, predicting future cash flows, just like the earlier statements. Now, one part of assessing liquidity is studying the financial instruments, and we're going to do a whole chapter. But these include cash, contracts between two or more parties that create financial liabilities or assets. For example, I'm just trying. Equity instruments are ownership of other companies' shares. And we are going to do that in 315, a whole chapter on it. And the contracts between two or more parties are things like forward contracts, kinds of derivatives, and so on. And you will do that in 316 and 410. Now, our balance sheet, love, statement of financial position has some problems with it, just like the income statement did. Current value is not reflected 100%. Let's put that. So as we talked about last chapter, when you've got a piece of land and it's sitting on the balance sheet at $20,000, $2 million now, that may not give a good, accurate assessment for a user. So current value is not always reflected, so land would fit here. Estimates and judgments have to be used. We do it when we do A for collections of receivables. In assessing the saleability of inventory, determining the useful lives of long-term assets. So we use estimates all over the place, which can't. Otherwise, if we wanted to amortize something, we'd have to wait till it wore down and broke, or we got rid of it to then go amortize. So our investors don't want to wait for that. Okay, on page 2, the balance sheet omits many items that are financial value to the business as they can't be recorded objectively. Assets such as the value of the value of a company's human resources. Okay, so that's a big one. So it's all their employees. Imagine two companies that are identical, but there's much higher turnover with their employees. Maybe the manager is not so great, or they don't give them enough training, or whatever. So that's not in there. Research and development and internally generated goodwill are not reported. Now you'll find there's rules for this. For example, if you were a pharmaceutical, there's different rules when you can recognize things. Internally generated goodwill, that's things like you've been in the same location for 20 years. Does that add to the value of your business? Yep. Can we record it? Nope. Some liabilities and commitments, such as leases and certain contractual arrangements, are reported in an off-balance sheet manner. So they manage to keep it off the balance sheet. Usually it's done with liabilities. For example, in leases, which you will learn later this semester, 316. You'll see the difference as to what off-balance sheet means. For example, let's say you were renting equipment for your manufacturing business, okay? So if you just rent month to month, you put it as an expense, right? Equipment rental expense. You credit cash month after month. However, let's say you had signed a lease for that equipment and you had signed up to keep using that equipment for 5 years. Technically, you owe them, if you can't get out of the lease, the whole 5 years. So that should be a liability. So that's the kind of thing they're talking about there. Again, don't worry about it too much. You'll talk more about it when you do leases in 316. Now, the format of the statement, of course, similar items are grouped together with subtotals. Different characteristics of items should be separated. Individual items should be reported separately in sufficient detail so that the users can understand the amounts, timings, uncertainty of future cash flows, to evaluate liquidity, how liquid their cash is. So if you've got cash tied up in long-term investments that you can't sell readily, that would reduce your liquidity. If your cash is in a money market fund that you can pretty much withdraw it whenever, then it is liquid. Financial flexibility, profitability, and risk. And it should help to calculate important ratios. For example, the current ratio. You can't just list all your assets together because you couldn't do a current ratio. You guys remember what the current ratio is? Current assets over current liabilities. Okay, the format. Now remember, you guys, you learned all this last year or whenever you took it. So if between my note, this text, it's just confusing and you still don't know, go back, look at your notes, look at your text from intro, and look up the balance sheet. You probably did it in about chapter 4 or 3, something like that. And same with the chapter 4 items, the income statement and retained earnings. That's a good source. Okay, let's look at the format. We've got current assets, and they expect to be turned into cash, sold, or consumed within a year or the operating cycle, whichever is longer. So operating cycle means how far from when you finished a whole cycle of selling, getting the product and selling it and collecting the money. So a grocery store, how often do they turn over their items? Probably within a year. Maybe if big on produce, you know, it's all fresh, organic kind of food, no canned goods, that kind of stuff. It could be much less than a year. But we will take the year, it's longer. So basically we want the minimum operating cycle to be a year. On the other hand, what if you were bone? Well, by the time you get the contract, start building the plan, and send it out and get paid, that's going to be greater than 1 year. Intent and marketability, important in classifying assets. Generally presented in order of liquidity from most cash to least. Now, restricted cash is listed separately, and it'll be either a current or long-term asset for it. So restricted cash, if we had, the bank said we'll lend now $20,000 all the time, then that would be restricted cash. It'll be listed separately, and let's say we had to pay them back in 10 years, it would be long-term. If it was we were gonna end up paying off the loan in a year, then it would be current. Okay. Cash includes cash equivalents, such as demand deposits and short-term liquid investments. Inventory recorded to LCNRV, or cash and net realizable value. And don't forget, manufacturing firms will have raw material inventory, work in progress or process, and finished goods inventory. Okay, long-term investments. These include investments held in a period of time. Non-current investments are debt securities, so another bonds, equity security, another company's stocks or shares. Sinking funds, tangible assets held as or other. So, like land held, future building site. Okay, and the valuation options are fair value, amortized cost, or the equity method. So this on in a later chapter, and then in 410. Oops. Okay, so that was